All right, welcome everybody. We're here for our quarterly update for our clients on how things are going with the markets and our take on what's happening around us, as well as how that's impacting our portfolio designs. I'm Chris Boyd, and I'm here with Brian Regan.
Hi, everybody.
And we're going to hopefully give you a lot of information to give you a sense of confidence about what's happening, how we're trying to respond to changing dynamics in the economy and in the markets. So, Brian, why don't we get started? As we do for everybody, our plan for today is we're going to start by going over some of the changes in the portfolio and the decisions that led to them last quarter, our assessment generally of how those turned out. Some of the changing dynamics that we think are relevant in the moving the markets as well as potentially the portfolios. We'll look at business dynamics, what's happening in the global macro landscape, consumer confidence issues, economic data generally, and how that affects your investments. And so what are our takeaways and that. And then when we finish, we'll leave a little bit of extra time for just to share for anyone interested some of the tactical allocation changes in only a couple of our portfolios that might be relevant to. Okay, so let's jump in. Brian, what do you think? What should we talk about as the key takeaways to start us off from last quarter?
So last quarter ended up pretty good for us. If you remember, last quarter the theme was to stay invested but more defensively. As the stock market was about where we are today, we haven't moved too much. We made a position in gold, which outperformed intermediate credit, and we overweighted our low volatility position, which outperformed the market volatility in the third quarter. So that was all good. As far as the global macro, we're underweight the global index pretty significantly for our international stocks, and domestic stocks have continued to outperform international stocks. So again, that was a great positioning. For some of our, along with our theme of staying invested but more defensively, we added a utility position last quarter that was one of the best performing sectors in the market for the third quarter. And blended large caps, I mentioned that we had added into that. It outperformed the small and mid cap stocks, so we had good stock positioning. On the fixed income side, we've continued to underweight credit versus our investment grade allocation. Investment grade has continued to perform really well with less risk than credit, so it's been very positive. As far as curve positioning, we underweighted intermediate versus our short positioning. This was neutral. It didn't necessarily hurt the portfolio, but the intermediate part of the portfolio continued to do well, while the short portfolio did less well. Still performed pretty well. In the intermediate part of the curve, the gold and utility positions benefited because intermediate continued to do well. So all in all, I'd say that we had a very good quarter.
All right, great. So let's go on to talk about sort of our theme of this quarter. As we're looking at things, there seems to continue to be mixed messages. It's not that we hear a lot in the news about worries of a recession, and yet there is good news. We continue to see some good things from the consumer, sense of optimism. Spending continues to drive the economy. By and large, we are still, although growth is slowing, we're still in a growing economy. Yet there continues to be things to be concerned about. Generally, when it comes to business, there's a little more of a sense of pessimism or anxiety, maybe a little bit of concern about what may be happening with trade policies and uncertainties coming out of that. And in terms of investments, it's showing impact on where businesses are putting their money and how they might be a little more hesitant to do that. So there's still things to watch, a lot of things to pay attention to. As we mentioned, trade policy continues to loom with uncertainty. There have been meetings and discussions with China, but when you get right down to it at present, nothing's really been resolved as it relates to that. Um, Perhaps we'll see some movement on what's happening with Brexit. We'll talk more about that in a little bit. Monetary policy, mixed bag. Generally, kind of not so great in terms of, with fiscal policy. We continue to spend a little more than we have coming into the government. When it comes to monetary policy, the Fed is trying to be sensitive to some of these issues. So, and on it goes with these various areas of focus. And we're going to talk a lot about some of these as we go through. So, short, preview of what's to come. Kind of mixed messages coming from the various data points that we're going to pay attention to. So, Brian, why don't you walk us through some of recent business data points?
Yeah, well, I mean, along the lines of mixed messaging, you see that the manufacturing PMI for the United States has done really poorly. It was negative, below 50, which is trend, contractionary territory in both August and even worse in September. German GDP had a negative reading, so that's all bad news. However, if you look at the consumer PMI, it's positive. There's signs of optimism, as Chris was talking about in the previous slide. And even in the manufacturing PMI, you could see a little bit of an upswing in the emerging markets manufacturing PMI more recently.
Okay, so something to pay attention to.
So the manufacturing is the blue line, the non-manufacturing is the green line, and the composite, which is both non-manufacturing and manufacturing combined, is the red line.
And this is global. When it comes to the U.S., Brian, does this look materially different?
It actually looks very similar. You can see that the blue line there is around 47, 48. That's about where the U.S. is today. It's a little bit of an uptick, though, where the U.S. is trending down a little bit. The uptick's due to the recovery in the emerging markets.
Okay. So just that index, that PMI, is an effort for measurement of what their confidence is, what their expectations is for purchasing.
That's right.
And so it's more a measure of impression than it is about behavior necessarily.
Right.
But it's expected that one relates to the other.
Right. So, Chris, you asked about whether the U.S. and the globe are, if it's a similar picture. I think this chart from the OECD gives a good explanation to that. The red line is the United States in the chart on the right, and the black line is the world. As the lines cross over 100, then business confidence is more pessimistic, and when it's above 100, it's more optimistic. So you can see that they're pretty close to on top of each other, but overall, it's trending negative, and it's also pessimistic in general. You can see, if you want to see the good side of the mixed message here, in 2016, we were in worse shape on business confidence when we hit the 99 line, and we did not go into recession then. So
it's not necessarily definitive, huh?
Right, and PMI has actually crossed below 50 3 times in this cycle. So it's not a guarantee that we're going to have contraction, but it does mean that part of the economy, the manufacturing part of the economy, is going to be contractionary.
So it's showing signs of concern, but not necessarily a definitive outcome.
Right.
All right, what about this global macro risk?
So we've shown this chart for a few quarters now, and it still continues to be interesting, in my opinion. Germany has fallen a little negative, and there's concerns there of a possible recession in the near term. Yeah. Brexit, that situation has gotten cloudier and cloudier, but it looks like it's going to continue to be delayed for a deal with the EU until Parliament can decide whether or not they can work something out. And the China trade tariffs have continued to slowly deteriorate, and the market has really moved along the rhetoric of what's coming out of Washington and Beijing. So, we have a couple slides that go into that, and I think are pretty interesting.
Incidentally, Brian, I had a caller on the radio the other day who seemed to say that he didn't think that tariffs really were having a negative impact on U.S. Consumers because it may be somehow subsidized by China in some fashion. I think the point is, anytime you have this kind of uncertainty out there, there's negative consequence to the consumer in terms of their cost. There's negative consequence to manufacturers because of their increased costs in China, in this case, that may be adversely impacting their sales and so forth. And it creates a lot of uncertainty in the world around us, which can have this slowing effect on what employers do.
Yeah, I think you're 100% correct, and those things don't happen overnight. Sometimes they happen with a lag of 8 months to 20 months. These things don't impact the economy immediately. There's a lot of things that can happen in between.
So, okay, we're hopeful then, as it relates to Brexit, that perhaps this will find some resolution in a smoother way than we were concerned about with this October 31st deadline. There's a lot of news coming out daily at this point as it relates to how this will play out.
Nothing definitive.
But nothing is definitive, so we're eager to see how that transpires. Okay.
So this slide I thought was interesting that I put together. I wanted to walk folks through the kind of volatile year that we've had and what caused it all, because earnings expectations on a 12-month rolling forward basis haven't really changed. They've been around $175 operating earnings per share. So that means that in January, looking through 2018, the market was expecting $175 earnings per share. And today, looking through to October of 2020, the market's expecting $175 operating earnings per share. So what does that mean? Generally speaking, you wouldn't expect the fair value for the stock market to change because it's a function of earnings. And you might say, Brian, it's ridiculous. Stock markets have changed a lot this year. It's true. It has been a lot of volatility. So this chart starts back at the beginning of the fourth quarter of last year. And you might all remember that we had a big 20% correction. The market was a little bit overvalued at the beginning of this correction in October. And then after the correction started getting momentum, it was exacerbated by year-end tax loss harvesting, which made it really, onerous. And then you'll see right at the beginning of January, maybe at the very end of December, we started to see a huge rally in the stock market, which was a recovery from the tax loss harvesting. You can almost draw like a technical line to where those began and end, the tax loss harvesting. Mm-hmm. And then the market continued to move on momentum, positive year-over-year earnings growth, all quiet on the trade front towards the end of March, April into May. And then things got a little interesting on the trade war front beginning in May.
So you want to take a closer look at that? Oops, a little closer look at that.
Yeah, so you can see starting on the left, the market continues to move on momentum and positive year-over-year earnings growth. That's coming from the last chart, getting into April. And then May was plagued with heightened tensions of the trade war, with additional tariffs going into place, Huawei restricted from doing business in the U.S., Trump threatens tariffs on Mexico, and then we had a pretty steep decline in the market. And keep in mind, earnings expectations weren't changing much again, but we saw a lot of this volatility. June, again, the administration was very quiet on the trade war front, which seems to be very good with the market. Both sides said that they were talking, satisfied market participants. Market stormed back up to 2,900 into July. It started expecting a rate cut. The market started expecting a rate cut. We got in over 3,000, which is where we have been recently. And then the market got its rate cut and kind of sold the news, right? The market corrects the overzealous optimism. Trump talked about announcing $300 billion in additional tariffs, which he put into effect. That's kind of starting a little bit this month and then completing in the after Christmas for the rest of the $300 billion. Mm-hmm. And since then, the markets quietly continue to grow over 3,000, as even though there's been a lot of political headlines, the trade market since the end of the summer has been relatively quiet, even a little optimistic as the vice premier visited Washington at the end of September, at the beginning of October.
Okay, so that leaves us where we are. Then, by the way, for those who were wondering, this is all the S&P 500 as the gauge of the market that we're referring to. I know a lot of people hear about the Dow Jones, but the S&P is a broader representation of U.S. stocks, large cap stocks.
And just to reiterate the point, the market really didn't change too much from year over year, but it's been a lot of volatility around headlines, especially beginning in May.
Okay. All right. So what's happening as it relates to consumers?
So back to the theme of mixed messages, I think the consumer is a nicer story than we're having in business investment, right? But even again, within the consumer confidence numbers, there are things to dislike, and
Pay attention to.
yeah. So for example, even though we're over 100, consumers generally optimistic rather than pessimistic. It is trending down and pretty significantly. So it's a question about whether the pessimism in business investment is kind of catching up with the consumer, and there are signs of that. But again, it's still positive, and when it's positive, it's 70% of the economy. Things usually trend up. The conference board is an additional gauge of consumer confidence. This chart here is from the OECD, but the conference board's metrics, which is the typical metric used, is also trending negatively for forward expectations, but generally still positive.
So, I mean, this is a great visual to kind of make the point. Although the numbers are still above the important measure, that 100, you can see the declining sense of that. So not necessarily at a point where it's suggesting we should be worried, but it's moving toward it pretty rapidly.
So in general, people are feeling good, just not as good as they were feeling.
Yeah.
And that's really the story there. Retail sales growth is another interesting metric, and I brought it up last quarter. Last quarter, I was a little more zoomed in on the 2018 to 2019 chart on the right. Here, I broke it out to include many other years. So you can see that when retail sales growth is over 5%, that's generally a very good thing. And when it's under it, it's usually not as good. Last quarter, we were trending from over 5% sales growth well down to 1%, and I thought it was a little bit more concerning. Since then, we've had a quite sizable pop, so that gives you some increased optimism, for lack of a better word. But again, the mixed messages, the theme of this quarter. Walmart has only had 1.8% sales growth. Target at 3.6% sales growth. The market rewarded these companies for having this what I would consider mediocre sales growth. So it's interesting. It's rewarding okay performance, which is something to keep in mind. The market's not really expecting robust retail sales growth. Some retailers like TJX continue to perform overall, but one of the things that I'm also concerned about is inventory to sales ratios remain elevated. So even though that we have good retail sales growth, one of the things when you look through the data, they're holding a lot of inventory on their shelves. It's not necessarily moving very fast. And part of the reason for that is a lot of the inventory buildup got pulled forward before tariffs and after the trade cuts. So that could lead to discounting, which could be
hurt earnings ultimately.
Hurt margins and earnings ultimately.
Yeah. So and therefore the price could be at issue.
Right.
Or the stock values.
Here's an unabashedly bright spot. So where there's some negative in the business investment, the labor market has undoubtedly been a good thing. Good. Obviously a mixed message once again.
Yeah.
Seasonally adjusted claims haven't gone down, which I guess would be the most ideal situation. That's because they can't really go down much further. But they also haven't gone up. They've stayed relatively, flat at around between 200 and 225,000. Wage growth has been unabashedly good. It's closer to 4% now, which is great for real wages. The CPI, depending on how you measure it, it's between 1.7 and 2.1. So that's good for the average worker who's clearly getting a bit of a raise relative to prices.
So that's good. But it does show that balance of some good, some bad. Let's talk about some economic data and how this affected portfolio designs and so forth. When it comes to, we've used this slide before as well. It's a J.P. Morgan asset management slide that kind of shows the movement of the price-earnings ratio, the forward-looking price-earnings ratio on the, I think this is the S&P 500, yeah. So you can see here, it's pretty darn close to the 25-year average, maybe just a little bit over. So what does that mean, Brian? Markets are relatively fairly valued as maybe just a little bit overvalued.
A shade overvalued, but nothing crazy, and nothing to get excited as a buying opportunity either.
But it also implies that that's based on the expectation that comes true, that the earnings that we're expecting remain kind of the same.
Right. Again, it's kind of mixed messages, right?
Right.
There's not really anything good. There's not really anything terrible here. It's very much average.
Very good. Tell us about this point.
So this is an interesting slide that I got from a Fidelity investment seminar that I went to recently. And the point that they're trying to make here is that the difference between the nominal GDP of the United States and the 10-year Treasury of the United States on a percentage basis has really gone away from the norm. Normally, in general, they're a little bit correlated. The reality is they're probably going to converge a little bit in one way or another. So what does that mean? It means the GDP could continue to be positive with a decent amount of inflation, could stay at 4%, in which case I would expect the 10-year Treasury to rise. Right? Bad for your intermediate bonds, but good for the overall economy. The other thing that could happen is the 10-year Treasury is clearly pricing in a recession, a dramatic decrease to growth, and GDP could follow it all the way down. So we're at a clear inflection point where one of the two of these things could happen. And you have to carefully design your portfolio where it's going to perform in either one of these scenarios.
So this makes it really hard for that in that last point, how to structure things, because if you knew which way it was going to break, you could plan the portfolio to be ready for that, one more pessimistic, one more optimistic kind of impact.
Right. So again, with the mixed messages, right? So the 10-year Treasury is taking a side that things are going to get worse, which is more like the business investment side of things. Mm-hmm. And the GDP line is trending like things are going to continue to do well, like maybe the consumer confidence numbers.
Right. Okay. So we'll elaborate on how this plays into our thinking in just a moment when it comes to structuring portfolio design.
Right. So fixed income, we've talked about this in the past. The yield curve is very, very important when making your fixed income asset allocation. It's difficult to explain and even harder to understand, but I'll always try to do my best. So if you pay attention to the chart on the right, the red line is where the yield curve was 6 months ago. The yellow line is where the yield curve was a year ago, and the blue line is where the yield curve was 3 months ago. When generally speaking, when the interest rate is really low and getting lower, the market expects inflation in the future, and the yield curve should steepen. 3 months ago, you could see that this wasn't the case at all. The yield curve was inverted. It was getting more inverted.
Just point which one is the 3 months ago. The color again?
The blue line is 3 months ago. And my expectation at the time was, in the medium term, that the blue line was going to go towards the yellow line in terms of shape, in which case my intermediate bonds wouldn't perform as well as my short-term bonds. And you can see that this didn't really play out in the first quarter, and we were positioned closer to the shorter end of the curve. But it's definitely starting to happen now as the yield curve is steepened. It's no longer inverted between the 3 and the 10 month, 3 month and the 10-year, and we're starting to get some steepening as expected. So we've positioned our portfolio accordingly.
Okay. All right, so let's turn our attention to what are the key takeaways from this mixed messages theme, and how will that play into our designs when it comes to our client discretionary portfolios?
Sure. So business investment is negative and getting worse. Consumer confidence is positive but getting worse, and the labor market is healthy and holding steady. It's clearly going one way or another, right? As saw in the inflection point. Again, I think the theme's going to be stay invested but more defensively, with a caveat. It's difficult when you are underweight duration to have a significant stock in your portfolio because there's not that natural hedge there.
It's not a ballast to it, yeah.
Right.
Yeah.
And we can't be longer in duration because we expect the yield curve to rise. So how do you create a portfolio that will do well if the 10-year rises as the green line meets the blue line in that inflection point chart, and that will do well when the blue line converges to the green line in a recession-like situation.
Got to be prepared for either possibility.
Well, what you can do is you need to underweight your equity a little bit, but you can make up with that with senior secured loans, which is one of the big changes that we're doing this quarter, which is a riskier bond loan, but it is a bond rather than equity, where we expect to make some return, but on a risk-adjusted basis.
Riskier, but not so risky because it has an element of collateral associated with it.
Right, it's secured, so that means that receivables and inventory is usually backing the loan, so you get some kind of return even in a worst-case scenario. We're maintaining our allocation to utilities and gold, as we expect those to perform well if things turn sour and our lack of duration can't help us as much as we would like. On the other hand, our short position in bonds will do better than our longer position in bonds if things continue to do well, and our bank loans will perform very well as credit spreads come in if markets do well. So we feel like we're positioned to perform well if markets do well, and really be positioned to in a risk-averse situation where we could take advantage of opportunities if things go poorly.
All right. Did you cover some of this, or do you want to?
We covered some of this, but global macro is going to continue to stay unchanged. In our fixed income portfolio, like I said, we're going to stay short versus the intermediate because we expect that middle part of the curve to rise as inflation expectations come up. And we're actually going to bring up the credit exposure a little bit, but we're going to bring down our equity exposure. So, that's one small change in our fixed income portfolio this quarter.
So in many respects, it's a continuation of last quarter's theme of stay invested, but do it more safely. But in this case, because of the bonds being a little bit more challenging as to how we might navigate them, and the fact that we don't want as much equity exposure without that intermediate term weight, we're discounting a little bit on the equity exposure, but not drastically.
That's right, Chris. Yep.
Okay, well, that is about the focus of what we had planned for our prepared remarks. We do have a couple more slides that we will share for those who are in a couple of strategies that are more sector-oriented. These particularly are people who have a 60-40 strategy with us. That is a core and explore, a little more tactical in nature. And then some of the people who have the 85-15 designs will have some of these aspects as well. For everyone else, that's it for now. And then we will just cycle through these slides so that you have a chance to take a look at them for the highlights. If you have any needs for, as you're looking at what's going on in the markets or in your family life, with your portfolio, with your financial planning, whatever it might be, if you think it's time for a get-together, please reach out to our office. Our number's right here, 508-771-8900. Or for those of you who work with our Dedham office, 781-461-1878. Feel free to give us a call. We'll schedule you for an upcoming get-together at a hopefully mutually convenient time. All right, that should do it for now. We will be heading into the year end. And of course, for taxable accounts, that does mean you may see some additional trading as we look for opportunities to offset capital gains with potential capital losses. And we're happy to talk to you about that as well. Anything else, Brian?
That's it.
Okay, thanks, everybody. Talk to you soon.